Okay, good evening, everyone. Welcome to Gender Center for the Global South. First, I will start briefly introducing myself. I'm Dr. Hebatallah, the Executive Director of Gender Center for the Global South, and I will be responsible for moderating this session today. I feel greatly honored to welcome our eminent guest speaker, Professor Tara. Professor Tara, a world-renowned expert in microfinance and poverty reduction. Professor Tara is a professor of economics at Gujarat Institute of Development Research in Ahmedabad, in India. Her research mainly concerns issues in policy and institutional development in the areas of small and microfinance, financial education, women and development, livelihoods and political economy of media. She has contributed to the discourse on the Indian microfinance in the 1990s through research, studies and policy critiques. Particularly, she has looked at the connection between the moral, social and economic aspects of the working of microfinance in India. Of course, today we are honored that Professor Tara is here with us, and she will talk to us on a very important topic: finalized development, household indebtedness, and gender. And of course, she's going to talk about the Indian experience. She's going to share her expert opinion on how financial inclusion play an important for poorer women in India. So as we all know that we are having short time for our session. So we are going to break this into two distinct parts. At first, our guest speaker is going to start her presentation, then we'll end the session with Q&A section. So I'm asking please all the attendees to prepare your questions and write in the chat box. And please make sure that your questions are concise and use please short sentences to express yourself. This session is going to be recorded and will be available online later today on our official YouTube channel. So I'm going to hand over to my guest speaker, Professor Tara. That she's going to now to share her presentation, and she will start her talk with us. Professor Tara.
Thank you, Dr. Adam, and thanks. I must really thank you for this opportunity, because, being able to talk to, a group of young students is always, quite interesting, very very valuable. And may I know how much time do I have for the presentation, Dr. Adam?
We are having like 45 minutes, 1 hour, so take your time. You are having all your time. So you are having our guests, so you are having your time.
Oh, yeah, thank you. I think I'll definitely try not to kind of bore you with a long talk. But I think as my sort of my title suggests, I am interested in talking about a kind of a phenomenon, a kind of a concept, which has been in circulation since the 1990s, but which came to greater sort of use after the global financial crisis of the late 2000s. Even before that, we talked about financialization. We have interesting sort of literature, interesting theoretical sort of treatises on financialization, but the global financial crisis and the aftermath has really made the term more popular, and you see a lot of sort of disciplines, a lot of theoretical perspectives coming and informing this concept called financialization. Of course, economists dominate the crowd, but more than economists, there are geographers, there are sociologists, there are all kinds of disciplines who really started engaging with this term called financialization. So it's evolved into a very wonderful, dynamic sort of construct which we must perhaps engage with if you really need to understand, in my view, the contemporary phase of development that we are all witnessing. Or I think it is a very interesting sort of a conceptual category which we can engage with and sort of relate to some of the parallel theoretical developments in other sort of sectors to make better sense out of this interesting game called development. So that's the reason why I thought I must talk about financialization. And a significant part of my presentation, especially the empirical details of the presentation, are drawn from a multi-state study that in India that I have just finished about a few months back on financialization of domestic economies in 4 states, Gujarat, Tamil Nadu, Orissa, and Maharashtra. So this was a multi-institutional sort of a project, though I led the project. There are scholars like Dr. Isabelle Gahen, who was a very important French commentator on microfinance and financial inclusion. My own colleague, Dr. Narayan Mishra, and another colleague from the Central University of Gujarat were part of this. They handled some parts of this project. So I am planning to draw from some of these learnings, and I focus mostly on my own experience in Gujarat, but I would try to kind of draw upon some other experience from other states. So let me start with my presentation. Give me half a minute. Yes, I hope you can see the presentation.
Yes, Professor.
Okay. Let me. Yeah. In a very sort of succinct sort of a form, financialization is defined as extraordinary presence of institutionalized finance in the everyday life of people. People like you and me, in our everyday transactions, we engage with more finance now. Financial instruments, financial technologies, financial institutions, financial, all kinds of financial relations that we engage with on a day-to-day basis. So that roughly can be captured by the term financialization, or we can say that we have all come to live by the dictum of finance. So the contemporary development phase is heavily financialized, is what this kind of the phenomenon tells us. And it has been explained as a macroeconomic phenomenon and relevant to mainly the mature kind of capitalist economies of the West, what we know as developed economies. And developing economies, which are patronizingly called the emerging markets these days, we see much little engagement with the concept called financialization. So my attempt in this presentation is to sort of argue that even in countries like India, where apparently the financial sector is not very hegemonic in its presence, we must be able to identify tendencies of financialization, and those tendencies have come to influence our financial behavior of household household financial behavior, especially of poorer low-income households. So that is the purpose of my presentation today, just to demonstrate how we can identify tendencies of financialization even in a country like India, which is not supposedly highly sort of a country with a huge presence of so-called institutionalized finance. Before I get to my empirical sort of discussion part, I think it is important for me to lay out the major features of what I understand as financialization. And financialization, as I told you, is a process. That process has multiple sort of features, multiple characteristics, and different people have emphasized different characteristics. And I try to kind of put together some of the major trends which have come to be recognized as characterizing financialization. One of the major characteristics is ascendance of finance capital and the emergence of a new financial architecture. And we know that financial deregulation has been, in vogue since the 1970s. Since the time, we really see that financial capital has become a very dominant presence, and the financial architecture has become a very dominant presence in all countries, that we know of. And as a result of this kind of a ascendance of finance capital, finance is also risen to be an autonomous business activity now. So it's not something which aids real sector or real production sector. It is a business activity in its own right, and it is increasingly attractive to investors who are in search of sites to invest so that they can make they can grow their profits. So it's a very attractive destination of investment these days. You must have really learned about innovation in the financial markets, like structuring of financial products, and huge innovations and technological interventions are kind of done, carried out in finance sector as a very autonomous sort of an activity. And another associated feature of financialization is increased emphasis on shareholder value maximization. Like, when you talk about non-financial businesses, not financial businesses per se, even the non-financial businesses, that what we call as activities in the real production sector, are increasingly driven by the desire to maximize financial value of shareholders. Some of the studies, if you really look at financialization in the macroeconomic context, the studies have really, proven that even the non-financial companies, if you look at their balance sheets, maybe increasingly larger proportions of their income now comes from financial incomes and not from profits, profits by selling and manufacturing and selling their commodities. So finance has become a very important source of income even for non-financial companies. Coming to the banking sector, this has been really noted in almost all sort of countries, in India especially, that the banks have become increasingly disinclined to lend to non-financial businesses. There is a huge debate as to why the banks are not lending to industries, why the banks are not lending to productive sectors like agriculture, why are they interested in lending more to personal, as personal loans, or maybe they are channelizing a lot of resources to shadow banking companies, which in turn mediate the financial market. So we definitely see this kind of a tendency on the part of the banks not to lend much to kind of businesses at all. But at the same time, they are interested and inclined to lend to households, which or add to the debt of the household. So they're lending to the household sector increased, and maybe they're lending to the real kind of production sector has slightly slowed down. And as I told you, there are a lot of lending you see from even Indian banks to shadow banking institutions. I think in the Indian context, the non-banking finance companies are generally known as shadow banks, though there is an argument saying that NBFCs are not pure shadow banks as we understand in the West. But still, you see a lot of financial resources, bank finances are flowing into these kinds of banking institutions, non-banking institutions. In essence, we say that there has been a growing disconnect between the real sector and the financial sector, the real economy and the financial economy. You don't see much of an integration between the real production activities. We lament that the manufacturing sector is going down, but at the same time, that our credit card penetration is going up. We are celebrating that our digital payments are going up, but we know that our manufacturing sector is really sort of facing a huge sort of a crisis in India. So we see that these two sectors have become increasingly disconnected. So this is what broadly are some of the important features of financialization. One of the critical feature that has not been discussed much, but I think which is becoming more manifest these days, is the financialization of social policies. I'll explain it a little later. What do I mean by financialization of social policies? But at the beginning, let me just say that what I mean is what was earlier the sort of site and instruments of social policy interventions are increasingly relegated to the financial sector these days, be it pensions, insurance, in different sectors or whatever. So earlier we associated all of those activities with state provision, social policies, and all that. Now we are largely thinking about them as part of the monetary policy of the central bank, or the credit policy of the central bank, and things like that. So a lot of social policies we see as being sort of pushed into the financial sphere. So these are all roughly the strains that have been identified by the extant literature on financialization. As I told you, there are multiple disciplinary perspectives on this: economists, sociologists, geographers, development studies. All of them have contributed to expanding the scope of inquiries beyond the developed regions to include the emerging markets of the world, developing countries or emerging markets like India. But if you look at the literature much more closely, we see that the focus is still on economy-wide macro trends. We don't see much of inquiries into the micro manifestations of financialization. Now, we are largely talking about the larger trends, as I told you, about the banking sector, or the financial business sector, etc., etc. So my attempt is also to try to find out how would it look if we sort of extend the scope of this discussion on financialization to the micro spaces. So I use little case studies to kind of argue my points. That's where we can have a fruitful discussion also, I think. So the micro elements or the micro manifestations of this larger macro process of financialization is what I would be speaking about. Coming to India, as I again, and as I pointed out in the beginning, there is an argument that in India, finance is not a very hegemonic sort of a presence. It has not assumed a hegemonic role in India, because the Reserve Bank of India, which is a central bank of the country, it's a very pragmatic and gradualist sort of an institution. It's very prudent in its approach. So it still sort of retains its kind of leadership position within the financial sector. So it's not very sort of timely. It's very premature to talk about financialization is the kind of an argument that you come across in the literature. And it is also true that the macro level tendencies are yet to become visible in India. If you look at the company balance sheets, they still do not clearly reveal that these companies earn much more from financial incomes. Or if you look at the balance sheets of the banks, you may not find a very kind of clear trend in terms of their balance sheets. Their assets are as high in some of the advanced the financial assets. So they still have a balanced sort of a balance sheets, both financial and non-financial companies. So that's the argument which generally sort of we make in terms of to argue that maybe financialization is a Western developed country phenomenon and not something which is very relevant to a country like India. So my effort is to sort of argue to the opposite. Yeah. Yeah. And I start with some indicators that I think are important from the banking sector per se. The bank lending figures, as we see from the RBI data. Over the years 2008 and 2020, a fairly large time period, and that's also the time period which broadly sort of coterminous with the financial inclusion, financial expansion phase of bank-led financial inclusion or financial expansion phase in India. During this long period, fairly sufficiently longer period, lending to agriculture in India grew at just 7%. But the compounded growth rate of lending to NBFCs, whom I consider as shadow banks in the context of India, the lending grew by 20%. So when the banks were lending to agriculture, the growth was just 7%. The bank lending to NBFCs grew by 20%. We can argue that maybe it has a base effect and things like that. It still matters that that kind of a jump really happened in terms of, and there are other implications of that even in the non-performing assets sort of crisis which NBFCs are facing over the past few years. So there are interesting, or there are very disturbing implications of this kind of a higher growth in that lending. And if you look at industry, which is the other real kind of production sector, bank loans grew at 10%. But look at personal loans. Personal loans grew at 13%. That was the rate at which loans to personal loans is essentially personal loans to individuals, loans to households, etc. So there was a higher rate of growth in the personal loans and to shadow banking institutions compared to the productive sectors like industry and agriculture. If you go down, if you slightly narrow the time scale to 2015 to 20, because 2015 is the year when financial inclusion became, a very accelerated kind of a project in India, 2014-15. So if you look at that period, advances to agriculture grew just again by 7%. It was still growing at 7%. And we definitely do not know how much of that was actually directly going to agriculture, because, we have merged the direct and indirect categories in India. Now all lending is considered as direct agricultural lending or agricultural lending per se. Industry lending grew just by 1.5%. Whereas NBFC loans, NBFC lending still was at a very high rate, or the highest rate at 17%. So there is definitely the disintermediation that I'm talking about, the disinclination of the banks in terms of being to participate in the real sector or the real economy is somehow borne out by some of these figures, is what I would like to argue. So, the growth of shadow banks is an important aspect of the financialization process of India. So, if you really, if I want to really look at the first tendency, first trait of financialization in India, I would say that is the growth of shadow banks, especially over the past 2 decades or so. The other important, yet less talked about manifestation is the increase in household debt. And I'm especially focusing on poorer households, and with the women bearing a disproportionate burden of borrowing and repayment. Not only that, the poor households are sort of brought into the financial sphere in some way or the other. The women have become the kind of bearers of this burden of loans, or like debt. In both in borrowing and repayment. So I think this is the second important aspect of financialization that I consider as characteristic of the typical Indian, financialization model. So I am going to focus on the second aspect of, financialization, that is household level indebtedness, and how women are part of that process. And as I told you, I will draw some of the lessons that I learned from this large multi-state interdisciplinary study that we carried out over 2017-18, actually in 2016 to 2018, whenever I need to really draw on, some sort of empirical support. So let me start with, the first argument. The first argument is that debt and women's, labor market incorporation, there is a relationship between the two. There is a relationship between indebtedness at the household level and women's incorporation in the labor market. The significant aspect here is that women's incorporation has happened on very adverse terms to their well-being. So the terms have not been very favorable to women's overall well-being. That's my first argument. Women, if I think that I'm as I told you, I'm really drawing from the kind of insights and the learnings that we have had from this study. So I'm just going with the broader trends. If anybody has any specific questions on these things, I would be able to answer them during the question answer time. But I'm now sort of focusing on highlighting on the major learnings that I would like to present in front of you. Women are permanently trapped in the loan circuit of shadow banking entities, and microfinance institutions form a very important part of these shadow banking entities. And of course, they're also getting increasingly entangled in these kinds of financial relationships with other non-banking companies, maybe vehicle kind of loan companies, or loans which really, so the companies which really deal in some sort of merchandise, like all kinds of non-finance companies have really proliferated in India. And women have been sort of brought into their purview too. So their women are poorer women from poorer households are increasingly engaging with these kinds of new financial institutions. And in our study, if I take Ahmedabad and Orissa, that is Gujarat and Orissa, and the cities of Ahmedabad and Bhubaneswar, overall, 54% of the new loans during the field survey that we did in Ahmedabad during 2017-18, and about 75% of the loans that we came across in Bhubaneswar urban, they were from MFIs, they were from microfinance institutions, and all of them are in women's names. We know that microfinance institutions are largely interested in working with women. And the amounts, if you look at it, they really account for almost half of all the outstanding loans that the households that we had in our sample. And let me also tell you that these are not one time. In the case of Ahmedabad, we have really followed something called a very something which very close to an ethnographic sort of a method, where we were visiting these households, almost about 36 households in the urban sample. We also did a kind of a rural thing, which I'm not presenting now, and we were visiting these households almost every once a week. And we started with a very sort of generic sort of an interaction with them, with large village meetings and general discussions with them. But increasingly over this 1 year, about 8 months in total, we focus more sharply onto their financial lives and financial behavior. And so the insights are generally coming from that. So it's not from a one-shot survey where we collected information, processed, and telling you. We have observed these households for a fairly longer period of time. Even in Orissa, we have done multiple rounds of surveys to really note the changes which have come in the same set of households. So that was a larger sample, about more than 100 households. So we have devised our own ways of understanding the largely unsteady, volatile economic kind of behavior and base of the households that we wanted to study. So these figures relate to those households. As I is about this is very interesting. If you look at their bank linkage or their relationship with banks, that is the banks in the conventional banks, 87% of individual members in the Ahmedabad households and more than 70% in the Bhubaneswar households were bank linked, in the sense that they had bank accounts. They had a bank account. Many of them had multiple bank accounts. Some of them opened, bank accounts to receive some government payments and then to receive some other benefits. And then when the LPG subsidy, the cooking gas subsidy came, they opened another bank account. And very often they were also asked to open new accounts under the Jan Dhan Yojana program. So many of them had multiple accounts, most of them defunct. And the bank accounts, very interestingly, the bank accounts were, the women owned more number of bank accounts than men. Because it's the women, that also is an indication that it's the women who deal very actively in the financial transactions. They are the ones who borrow from this, non-banking institutions. They are the one who receive very often the benefits from the state through the, banks. So they are the ones who became suddenly very active sort of agents in the financial space. And most of the accounts, as I mentioned, were opened under the financial inclusion drive of successive government drives since 2006, 2011, 2014. Bank accounts are mainly used to receive government benefits, as also they receive their loans from MFIs, MFI loans through the bank accounts. So the bank accounts, either they use to receive benefits, or they used it as part of the Jan Dhan Yojana scheme, the financial inclusion scheme, or they have opened it to receive MFI loans, microfinance bank institutional loans. But at the same time, we found in both places, and even in other states like Tamil Nadu, very large extent, and Maharashtra, the informal sources of loans are still, they still continue to be extremely attractive to women. Be they goldsmiths with whom they have a mortgage-based relationship, or money lenders, the conventional money lenders who work in multiple ways, like some of them behave like microfinance institutions with the same kind of models, like they come every week and they work through groups, or informal sort of traditional informal channels, or channels which are sort of more employer based. So there are different ways in which informal lending prevails very significantly in all the neighborhoods that we visited and studied. And we also kind of found that debt is significantly present, but the incomes are highly fluctuating. So at the end of the field interactions in Ahmedabad, if I report, the average monthly income of a household was about 19,380 rupees. That is less than $2 a day. That is 129 rupees a day per person per day. That's how, if you really bring it down by standardizing for the household sizes and all that. But at the same time, the average debt size was about 130,000 Indian rupees. So that's how debt and income were related. And a typical household was engaged on an average in about three different multiple activities, and each activity gives them about close to 6,000 rupees or 5,800 rupees. So, but every household had more than one economic activity which they sort of juggled through the day or through the week. The incomes fluctuated through the 8 months that we observed them. Multiple household members were getting in and out of the labor market. Once you go visit them, the son is working, the mother is sitting at home. A week later, the son is jobless, and the mother has picked up another job. So it's a constant adjustment in terms of their labor market, participation, to keep that, the income level at least closer to the standard kind of standard of living, their standard of living understanding. And we also found that the terms of subsequent employment opportunities actually deteriorate. In almost all the cases, when somebody loses a job and picks up another job, the second job is necessarily, or in almost always, or is on a term which is not as good as the previous job, which is again not what we understand as change in labor or changing work. And when you change employment, you generally rationally look for better opportunities and all that. Those kinds of rational calculations that we know of in the theory doesn't apply to some in the sites. So I've noted some individual cases because we have also placed about 15 individual diaries in these households. So we noted every transaction that they made, and not only loan and sort of savings, even other routine expenditure and all that. So from that, this is one of the case household I am presenting to you. You can see that between March 2016 and July 2018, you find several microfinance loans being infused into to this household. And these households are, as I told you, the kind of character they share, the kind of characteristics I've just described. So at any point in time, it simply means that they are servicing multiple debts. They're handling multiple debts at any point in time. And this is another household, again, between March 2016 and July 2018, about 6 microfinance loans have gone into the household, apart from about 3 private company loans. And these could be vehicle financing companies. This could be companies which sometimes combine different kinds of products, like a mobile phone with another gadget. Those kinds of companies which offer to give loans on easy installment basis. So many of these the selling happens very coercively, in some sense, in the sense that these are not rational process on either side. There is tremendous amount of coercion on the part of the company, moral coercion, social coercion, working through groups and coming through the microfinance groups. And there are various ways in which they approach these families. So these are not very economically, quote unquote, rational borrowing decisions. So these are the 2 illustrations that I have picked up just to tell you that this is how households interact with financial institutions. As a result of this kind of debt-ridden, fluctuating income sort of a scenario, women in these households are compelled to accept any work that adds some cash to the household economy. And almost all the women that we have encountered in Ahmedabad, urban Ahmedabad, and in Tamil Nadu especially, precarious income generation activities. And what do I mean by precarious income generation activities? Some of you would definitely know. These are employment opportunities which involve very low skill, low and uncertain wages, insecurity of employment, and lack of social entitlements. And they are working, they're engaging with these precarious employment or income generation activities through the day. Right from the morning till evening, they're doing multiple things. That's another interesting thing. They simultaneously deal with different work arrangements, in terms of timing, in terms of wages, in terms of networks, in terms of work conditions. So these are all different kinds of, arrangements. I think we found in one neighborhood, we found kind of, women who were working in organized factories, mostly as, contract worker. I think, they were working as, what do you call it, home-based kind of workers. But those women were very seriously affected by some of the some of the initiatives, some of the measures which were taken in the just preceding our kind of survey. There was demonetization and GST, and these women were taking part in the garment manufacturing industry as embroidery workers and those kinds of activities. And many of them, and we found many of them to have lost their jobs, or their work times have come down by the time we met them after this GST sort of thing. That was the second thing which happened after, in the 2016-17 time. So they were also, sort of left to look for these kinds of precarious activities, maybe, in the neighborhoods. And the average monthly earnings of women, it was found to be much less compared to men. They were getting about 2,090 rupees a month compared to males who were getting about 9,900 a month. So what I'm trying to say is that the drudgery is more, the way in which, the what do you call it, the intensity of interaction with the labor market of women is much more, but they earn much less, just about a third or a fourth of what men earn. So my argument here is that the continuous engagement in these kinds of employment, this kind of precarious work, it has also blurred women's perception about their own labor. If you sit down and talk to them about their work, they have this understanding about their work as very inferior, and as they're contributing supplementary sort of sources of income, or very transient, in the sense that I'm willing to do something else if this doesn't work. So they have a very transient sort of an association with the labor market. So that's why I said that it's inferior, supplementary, transient, and very lowly valued. And I'll tell you how lowly valued that could be. And these are some of the kind of items that women in Ahmedabad, kind of poorer neighborhoods, through the day, like it's drudgery in the sense that they are working through the day. They make party streamers, they work decoration material, they make some sort of, like auspicious sort of, pieces of cloth for gods and goddesses in our temples. And they just tie brand tags to some of these, the jeans and the dress that you wear. They keep tying, tags for them. And these are all very inconsequential activities, which doesn't really add any great kind of, intellectual or other value to these women at all. But this is very repetitive. They sit down and do this, making plastic flowers through the day, or stitching through the day, till about late in the night, some sort of little cloth piece for to be sold in the market. And they don't even know who they're doing it for. There is no employer, there is no kind of wholesaler in view. Somebody comes to these neighborhoods, give them the material, collects them, give them some sort of rejects the kind of their stock and gives them additional. So it's a very random happenings but happening very, very regularly. You can see these men, this representative of these, representatives of these kind of traders walking the streets of these neighborhoods almost every day, distributing material and collecting back finished products. And if they make about 200 to 300 party streamers, a woman get about 100 to 225 rupees. If you tie about 1,000 tags, you get 2 rupee 25 paise, which means, you need to spend all your kind of leisure time into these activities. And if possible, you also draw in the time of your children, like when they come back from school, you can see children sitting down with their mothers and doing this in order to make this kind of fairly lowly income. So this sort of a compulsion to constantly involve in this kind of work, you find more in those women who have a very active interaction with institutions like MFIs, because they have a continuous repayment sort of a cycle going on around them. So you need to, if you have borrowed from, about 5 MFIs, 3 MFIs, and if it is weekly, then you are sort of, almost making every week you are making 3 payments. And of course, on top of it, new MFIs would approach you, new companies would come to you, then your money. So it's a finance centric daily sort of life that we saw in some of these. I'm not saying everywhere it's the same, but where microfinance has penetrated significantly, you see this kind of dynamics. What's my concern in this kind of a scenario? My theoretical concern is that there is a lack of appreciation in our current scholarship, a lack of adequate appreciation in our current scholarship of the links between financialization, like the increased engagement, the accelerated engagement of households, especially poorer households, with multiple financial institutions and multiple financial technologies, and the structural changes that happen in the labor market. So we have great studies and great writings on labor market changes, but we do not have enough insights into how those changes are linked, are related to the changes which is happening in our development model per se, which is getting financialized in a significant way. And this is not the only mode of financialization. Labor market is the only site where you see financialization. I would talk about the other site of financialization in a couple of slides later. So in the labor market sphere, you see a lot of discussion around casualization of work, or voluntarization of work, or institutionalization of gig work, which are mediated through online labor platforms. Because the employers are looking out for shifting risks and maximizing shareholder value. So we don't realize that some of these transformation in the labor market sphere has happened because the employers are increasingly interested, increasingly worried about shifting their risks to some kind of an external arrangement, but at the same time maximize shareholder value. So the strategies are, very much informed or influenced by what I understand as financialization, or the process of financialization. The other thing which is very important is the financialized social care. And I consider there's a paradox of welfare in countries like India now, as social care is getting financialized. We claim that the benefits of transfer, as far as that is one of the greatest justification for digital inclusion rhetoric. That is, benefit transfer has become very, very efficient now, because there is very direct transfer into the bank accounts of the target population, and there is no leakage, or there is very minimum leakage. So it's a highly efficient form of transferring benefits, the digital transferring of benefits. That's happening on the one side. You are saying that you are efficiently transferring social benefits to the targeted population, especially women. But on the other side, on the other hand, the service provision like health, education, housing, that is exposed to market competition. So I get my benefits in an efficient fashion into my bank accounts, but I have to now pay full fees for my children who are going to private school. I do not have any state provision of health services. I need to really go to a private doctor. I really do not have, I'm not a beneficiary of any kind of government benefits with respect to housing. I need to work through the private market. So on the one hand, we say that social benefits transfer has been become more efficient, rendered more efficient. On the other hand, your basic service provision has been really pushed to the private market sphere. And the second kind of aspect of that would be the increased exposure of social security payments to the financial market. For instance, we think more in terms of market-linked savings. We are discussing more about pension funds. or we're talking about insurance even in spheres like agriculture and other areas and things like that. So social security has also been taken out of the public sort of a sphere, from the responsibility, from a fiscal responsibility sphere, and placed in the financial market sphere. So this is the paradox of welfare. I think we have not really found any resolution to this kind of a paradox, but that is definitely a paradox which we repeatedly encountered when we talk to the women, especially in urban Ahmedabad, where aspiration levels are very high, in spite of all this, sort of daily gimmicks they had to do. So social policies get financialized on the one hand, income savings and credit growth slows down. That's another kind of discussion. Like our credit growth I have already talked about, but even the savings growth in India has been really slowing down. So we also have, we encounter a very different kind of a development dictum now, which has become very popular as part of the financial inclusion narrative, and also by the digital financial inclusion narrative, that poor households live by loans, or loans lift households out of poverty. There's a very robust kind of theoretical literature which link financial development to household welfare. So I'm definitely not talking about it, which the kind of theories which we learned in the 1980s and 90s, which really linking these two. But what I'm trying to say is that the political translation of the theoretical sort of our theoretical understanding, unfortunately, has been something like this: that loans can lift poor households out of poverty, which has led to these households constantly juggling with multiple providers, so that they can manage their risks, shocks, and emergencies. So they're constantly kind of surrounded by these relationships. And we also have some sort of evidence to suggest that maybe the social arrangements of risk sharing, which were more prevalent in some societies, have become slightly destabilized over these years, in the sense that like you find that now there is a microfinance institution whom I can approach for a larger loan. I'm not really interested in perhaps approaching my the social circuits of loans earlier. So in a couple of instances, people said that we feel better now, in the sense that we don't have to really kind of forsake our honor while borrowing. So now we can. So they think it's a very professional relationship now they have developed. So social ties are slowly getting perhaps sort of eroded in this kind of a scenario. So even risk sharing arrangements may be slightly sort of ruptured in this. And that's one point which we need to explore further. And I would also argue that financial inclusion, that is a state strategy towards addressing marginalization of households, I think, and individuals, that also validates actually a model of financialized development. Because it has no reference to the real sector crisis at all. We are not, in the financial inclusion narrative has been too independent of the crises which are, very evident in the real sector. So these two are running parallel, and we have not made enough efforts to sort of, bridge the gap between the two. And financial literacy, financial financial education, financial literacy projects, I have had an opportunity to evaluate some of them. I think almost all of them are informed by a very non-local understanding about what is financial capability. You draw on some of these international agencies' understanding about what is kind of rational behavior, or what is prudent financial behavior. We have not really tried to incorporate the local understandings about financial literacy or financial capability into some of those debates. So they're also sort of, standing very sort of loose in this whole rhetoric as something which is, which is very technical and which is very managerial, which can be done through a series of training programs and things like that. So you can influence the culture and practice through those kinds of training programs. And I think that you do not see a kind of a very organic evolution, organic sort of development of this parallel narratives into something which is very comprehensive, which can actually address issues of exclusion. And we are also, the rhetoric has also been in terms of shifting the risks of the individual, not to any, any collective arrangement. I somehow believe that the financial inclusion agenda has been very seriously appropriated by into a political rhetoric. And in spite of about 5-10 years, 10-15 years of work, sincere work and serious work, and different parties have been contributing to that project, but we really do not have a very a rooted, embedded approach and understanding about financial inclusion at all. And at some point, and at the very critical stage in its evolution, we've also let it appropriated by the political, rhetoric, which I think is a great loss. We need to reclaim that those debates and try to really find out how financial inclusion and some of the social exclusion debates must go together. As I told you, how we should really try to see how the financial capability kind of issues can be re-wedded into our understanding about financial inclusion, etc., etc. So, but unfortunately, financial inclusion has been very simplistically translated into something like, you herd all the poor to the banks, make them open accounts, but at the same time, we almost leave them at the threshold of the banks when it comes to loans and financial services. So you said that, okay, you all go and get your accounts open, but all the loans are coming from non-banking institutions. I think there's a serious disconnect, in the financial inclusion project itself, which we somehow do not want to address sort of in any significant fashion. Some of the last points, and I think I'll finish in about, I don't know, I have not really checked my timing, but I hope I have 5 more minutes. I think 2 other phenomena also emerge from the experiences, at least of our study, which I sum up as microfinancialization and feminization of debt. That is, microfinance is the fastest growing segment within the non-banking finance industry, despite the liquidity crisis even in the non-banking sector in general. Even at that point in time, we found microfinance to really grow. Lending to microfinance borrowers, mostly women, has increased by about 900% between 2012 and 2018, from $2 billion US dollars to $20 billion US dollars. And microfinance non-banking companies raised close to 3,682 million through securitization deals in 18-19, which must have gone up in 19-20. That is up from about 1,400 million in 2017-18. We know, I just wanted to, all of you must be knowing these interconnections, but I think this is a micro loan. This is the channels through which a micro loan of about maybe 15,000 rupees, 20,000 rupees really traverse to become a highly sophisticated, structured product. And I think this process, to me, is at the heart of financialization. How a simple financial transaction between a lender and a borrower is, packaged into complex financial deals involving multiple sort of players, and through fantastic innovations, through the circuits and things like that. So this is, to me, is a very typical, very interesting sort of exposition of how financialization works in in developing nations. And if I go towards an explanation, let me just read this out for the sake of convenience and time. The new financial actors who assumed salience since the mid-2000s have instrumentalized women, especially poor women, as self-effacing bearers of financial obligations, whose financial behavior sustained their family's economic well-being and social honor. Women's everyday encounter with money and constant negotiations to fulfill repayment obligations have led to a dilution of well-being on the one hand and fracturing of social ties on the other. The rhetoric of financial empowerment deployed in India over the past couple of decades systematically and creatively reworks, or it has reworked, the many unfreedoms that women experience and entraps them in an ever-expanding sort of a, circuit of financial transactions that overlay each other in complex ways. In celebrating the versatility and benevolence of financial capital, the state has further abdicated its responsibility for social provisioning, leaving the space open to a new class of efficient and competitive social vendors. I call these players who really deal in social goods like livelihood security or empowerment and health, hygiene, education. A whole lot of vendors of these social services have emerged. So they have replaced what maybe the state has occupied earlier. The new development imaginary has also spawned a new lexicon wherein digital technology is coterminous with democracy. Social inclusion is a synonym of financial market expansion, and poverty is nothing but lack of entrepreneurship. The larger change processes in the big world of finance have serious implications. All these changes, all these change processes in these larger, magnificent world of finance, they have serious implications for everyday lived experiences of poor women, is what I have tried to demonstrate through this presentation. Thank you so much, and I would be extremely happy to address any queries that you have. Thanks so much.
Thank you, Professor Tara, for sharing with us your informative and insightful presentation on the different aspects of financial inclusion in India and challenges that are facing the financial engagement of women.
Yeah.
Would you please, Professor Tara, would you please open your camera? Now we are going to. So as we are going to start our Q&A section for our session. I have already asked my attendees to write in the chat box their questions and try to be concise and use a small sentence. If you allow me, Professor Tara, I would like to ask at first my questions. I will start by my question at first.
Absolutely, absolutely. Yeah, please.
Okay. I would like to ask about COVID-19 impact on the microfinance sector in India. And do you think that in the near future there will be like a consolidation of microfinance institution in India in order to be capable to meet all the challenges that has been caused by COVID-19 pandemic on the Indian economy and to be able to use the microfinance sector?
Yeah, please, just one second. I think I'll take my,
Yeah. So this is the first question. Have you got my question?
I know. Okay, could you please repeat it, Dr. Adams? Just one. Yeah, I must have missed some parts of it. Yeah.
Okay, so I was asking you about the effects of COVID-19 pandemic on the microfinance sector in India.
Okay.
First, and secondly, do you agree that in future post COVID-19 microfinance institutions in India, they are going to move toward consolidation? There will be like more consolidation movements in the microfinance sector?
Yeah. COVID-19, I think we have also done a small kind of, follow-up study just after, with the same sample households in April and June. It was extremely difficult for these women because they have defaulted all their loans, and they had lost their jobs. There was absolutely no income at the household level, and they were largely on government support and things like that, and but their loans were sort of rescheduled, or they were under moratorium, because the Reserve Bank has given that sort of a facilitation to microfinance agencies. So microfinance institutions were not collecting their loan installments, but they had to give it later. So these months until now, I would say that the repayment has picked up, because I also work very closely with some of the microfinance agencies. I know that for a fact that their balance sheets are becoming better now, because the collection efficiency has definitely improved. People have some of them have got back their jobs and all that. So maybe I would actually say that the collection efficiency must have also gone up, because the women know that they need more loan. So unless they don't repay their existing loans, they cannot be eligible for future loans. So that kind of a rationality very often, almost always, works with the women borrowers. So some of them are actually repaying their loans in some ways, so that they can avail larger loans, maybe because there's a great prediction of worse days to come in the at least a couple of years. So you see that microfinance. So I think in that sense, from the point of view of the routine borrowers, the habitual borrowers, I think there's a promise that, okay, if I repay with discipline, I'm going to get back some loans back. Microfinance institutions are not hugely bothered by this crisis. I think that's what my reading is. They're definitely worried, because their bottom lines have reflected that that the collections have gone down. But they're very hopeful, because, as I told you, a lot of deals have happened this time. A lot of money has flown into this, microfinance institutions. Their borrowing has not stopped from banks. RBI has facilitated through the TLTRO route and all that, some sort of infusion of capital into microfinance institutions, NBFCs and things like that. So as of now, I think it is as flux as many other sectors, but there is no foretelling of any doom now. And I also think that microfinance in India has gone through a multiple crisis now. 2006, 2011. So they almost have known that oh yeah, this too shall pass. So that's the reading I have of microfinance in India now.
Yes, thank you, Professor, for your answer. We are having questions that our attendees have shared. Sumit is asking, what is the difference between the financial capability and financial inclusion, and how they are related?
Yeah. Shall I answer one by one? I think that would be easy for me, so that I can.
Of course.
If that's okay. Yeah. The difference is very simple. Financial inclusion is the process wherein you get included in the larger financial sector. Maybe there are multiple ways of doing that. Maybe in India, the most encouraged way of financial inclusion is that you have a bank account. And you may start saving with the bank account. As I told you, you may save with the bank account, but those bank accounts may not really ensure you any productive loan if you want. That's a paradox that I was talking about. So that's financial inclusion, that you become part of the institutional financial sector. The instrument of that participation is an account, a bank account. So that is inclusion. Capability is something, your ability to deal with finance, your ability to understand financial products, your ability to understand financial relations, your ability to understand financial institutions. That ability is what financial capability, and also your ability to understand your own financial behavior. Why do you save? Why do you invest? Why do you take a loan? And what is the difference between when you borrow from a money lender and when you borrow from a bank? And how do you calculate your kind of interest? So I think it can be broken down into simple, sort of knowledge and skills about dealing with finance, to even broader understanding about how the system works. Do I know? I think, do I know as a microfinance client, how am I related to the larger industry? That sort of, I think I would say that is that sort of a thing. So that is capability. That's your capability. You are able to deal with your individual situation. You are able to make rational, prudent decisions about your own financial status, and also you understand the relationships that you engage with the larger financial world. Yeah, I hope, Sumit, you are happy with the explanation.
Yes, of course. So Abhijit Nair is asking, regarding your studies that you have mentioned, there was caste considered as a criteria. And he's asking, is financial inclusion uniform across the castes? And how efficient are the central and state policies in tackling the problem?
Okay. Yeah. Uh, we did not consider caste as a deliberate criterion in the study, Abhijit. But interestingly, if you survey the neighborhoods, poorer neighborhoods of Ahmedabad, they are called chawls or slums or charlies in the local language. These are all organized caste-wise. So within a slum, you find a caste cluster. So, it's a very interesting phenomenon in the sense that within a poorer neighborhood, you find, uh, small pockets where only one caste people reside. So at the end of it, we came about really representing a clutch of castes. But we did not deliberately include that into, that was not a criterion that we used in our sampling. But because our focus was poverty, like prevalence of or low income incidents, that was what we were looking at. But we deliberately included a few households who are from the minorities, area in Ahmedabad, because these are particularly backward. They're particularly socially and economically backward, and there's also the industrial belt in Ahmedabad. So we have actually taken the minorities neighborhood, about 7 households in old Ahmedabad, the eastern side of Ahmedabad. There, interesting things we have found. We found both a kind of a disinclination to engage with these kinds of, disinterest in dealing with organized finance, because that is not something which Islam really advocates. And hence, some people have decided not to get into borrowing for an interest rate and things like that. But there are other households who have been really routinely kind of engaging in the same kind of activities that others were doing. Microfinance was very much present in those areas also. That's very interesting. You can see microfinance working in those areas too. But you find more of social transfers through the zakat and things like that. Found families who are, very poor families who are sustaining themselves through those kinds of charity, community charity and things like that. So that's only a kind of explanation I can say in that. But in the rural study that we did in Gujarat, we have taken scheduled castes and Adivasi households. Why we found very, very highly anthropologically wonderful practices, those families still follow, which to some extent insulate them from against the onslaught of modern finance. That's a different story altogether. Yeah. And the second question is, how efficient are the central and state policies in tackling the problem? How is the COVID? I think the COVID pandemic, I think I have slightly answered, and even my answer to the state and central policies is, I think policies are. Let me put it this way: these policies are not rooted in the financial wisdom or the financial, the real financial behavior of local households. That's what I would say. So we have borrowed concepts from a whole lot of places, but we have not really embedded them in our own economic situation. Yeah.
Yes. So we had also as well a question. It is from Bangladesh, Professor Muhammad Zahir. He was asking about COVID-19, but he's asking about whether there will be microfinance institutions are going to think in newly and offer new product service to regain position during this stage of pandemic. He was asking about lessons from Bangladesh.
Okay. In terms of what the offerings, I think there would be a lot of livelihood focus if I follow the discussions in the boardrooms of microfinance institutions very, very correctly, there is a greater understanding that we need to really look at livelihood opportunities closely with microfinance. Because that is a shock that has been the severest shock as far as the pandemic is concerned. The livelihoods have been disrupted. So many of the MFIs are really discussing ways and means of maybe supporting collectives of farmers or other kind of livelihood activities, and how we can be part of that game plan in the years to come. So I think this disconnect that I'm talking about may be bridged to some extent in the future years if livelihood concerns come closer to microfinance priorities. So I think that may happen at least in the conscientious, microfinance institutions in India. And I think we have always looked up to Bangladesh for, some sort of, inspiring cases and evidences, etc., etc. But I have also closely followed I've done some studies in Dhaka and Chittagong some years back. And even I had some visits, made a couple of years back. So I think there's a lot of difference between the Bangladesh microfinance model and Indian microfinance model in some sense, because India has gone into a non-banking finance mode for organizing microfinance, and the policy is pushing, prompting, encouraging the non-profit NGO actors to become banking companies, and it's so that the central bank can directly sort of regulate them. So India has chosen to take microfinance growth in the regulated financial sector regulated path, so that there is a continuum between a smaller group and a small finance bank or a bank. So being a bank or becoming a bank is in India is the highest point where a microfinance institution can reach. So Indian Central Bank is definitely not willing to let go of its regulatory arm when it comes to financial activity. So as far as an organization remains a non-profit agency, it's good enough. But the moment it becomes an NBFC, and then of course it is a quasi-regulated entity. So I think that's one difference that I see between kind of Bangladesh and India. If I can say it. Otherwise, I'm also aware of a lot of evidences which are coming up even in Bangladesh about the downside of microfinance, or the little sort of inefficiencies within microfinance to be able to make that social transformation very real. We also have those debates in India, as you know. So those are some of the parallels I can think of at this point in time. Yeah.
Yes. And now, please, I call Dr. Lina Son. She would like to ask her questions. So please, would you unmute your mic and ask Dr. Tara directly?
Sure. Hi, Tara. It's been a long time. I teach at Jindal, which is why I heard about your seminar.
Oh, really? Okay. Great.
Sarah was advising me when I was doing my PhD many, many years ago, so it's been a while. Super interesting presentation. So I had a couple of questions. The first is, so you said that women's role has increased in terms of the shadow banking microfinance space. Does that translate into women's agency increasing as well in terms of what they're able to do with the loans? So that's the first question. And the second question is around digitization, especially the sort of increased use of mobile phones across India. I'm currently doing a study on women's access and use of mobile phones, and what we see is primarily there's an awful lot of increased controlling or monitoring of women. So we're not seeing much positive effects. Is that something you're seeing in, say, digital financial inclusion? Is that something you've seen among the women? Does them having a phone give them more agency in terms of how they use their loans? Or has it actually increased further monitoring by men in the family, whether it's the men getting the calls, the men receiving the PIN codes, the men receiving whatever it might be? So those are my two questions.
Thank you, Lina. Very, very nice seeing you. I think it's after a long time, as you said. Wonderful. Yeah. Women's agency, it's a very, quite a complex sort of an answer to that. If you think in terms of women handling money, in terms of making payments or, honoring debts and things like that, you see that they actually have become the agents. I would say that the central agents now in the household, at least in cities like Ahmedabad, or even some parts of Tamil Nadu, women are the central agents of this financial architecture. They are the ones who really bring money and also sort of channel that out. But whether that has substantially translated into their substantive freedoms, I don't think we have any evidence to say that. But at the same time, we need to also factor in the substantial shrinking of freedoms of the poor households themselves in making decisions, larger decisions. So that space also has shrunk, has become very constricted. So within a very shrunk space of decision making of a poorer household, women have been, that's why I said that women have been instrumentalized to carry out and to be the central agents. So it's a dicey situation. It is not something which we can celebrate because, in some sense, we are trying to say that the risks and burdens are actually on women's shoulders now. It was even, I think that was the argument even in the early days of microfinance. It is increasingly so now. We have women who said that, I think, my son's job is to make money, to earn money he gives me an amount every week, and it's me who who makes all the payments outside and things like that. But I don't think she would be able to make a substantive decision within the household because of that. So women have been instrumentalized significantly, and the males know that, and males are also importantly part of this game. Earlier, we were looking at microfinance as a women-only activity. Right now, it's a joint activity. Men are great beneficiaries of microfinance through, because they're mobilizing those resources through women. Because the stakes are high. Now, women are able to borrow up to 40,000-50,000 rupees from one single MFI. They can borrow from 1 to 2 or 3 MFIs. So I think, so they are dealing with larger funds now, especially in markets like Ahmedabad, which means men are there. It's not the earlier, amounts of 2,000s and 3,000s. We're talking about 50 and 60,000 rupees. So men are very much there, which means women's substantive freedoms are definitely not as we desire that to be. Digital thing, I think it's a double-edged sort of thing, as you said. Maybe if from our other work also, we know that digital technology has somehow empowered some part of, engagements of women, people who can afford, the women who can afford to have a phone for themselves. Most of the women share phones, the devices are shared. They no longer, they really do not have effective control over the device at all. I think I also wonder some of these mobile-based metrics hence must be very erroneous. Because if you're basing a device as the base in constructing your metrics, that's because it's always a shared kind of device most of the time. But surveillance per se has increased. MFIs right now can real-time monitor the behavior of their clients. I think sitting in an MFI, a fairly well-organized, efficiently, professionally organized, professionally managed MFI you can actually shock you, because they have this heat maps in front of them. They're constantly monitoring who is paying, who is not paying, who is where, and where are the women, are they traveling? It's not a very, it's not a very interesting thing. So digital technology has been definitely used or being used by some of these MFIs to very closely surveil women. But to some extent, ownership of digital technology has kind of made women, little more sort of, or enhance their agency to some extent, provided they're able to, own something for themselves, and they're able to operate, and they know the technology well. I know it may not be a very satisfactory answer, but I think that's how the situation I see now.
Thank you. Super interesting.
Thanks.
And
Thanks
really
so much.
Scary about the MFI surveillance, I have to say.
Yeah, it's scary. It's very scary.
Thank you, Professor Tara, for your answer and patience. So this is the end of our questions. I don't see any more questions. So before ending this thought-provoking session, I would like to express my gratitude to Professor Tara for accepting my invitation and making her time to join us today. and of course her patience in receiving and answering all these questions and giving that much depth of replies. So thank you so much, Professor Tara. I'm personally appreciating all your efforts. And also big thanks goes to our active participants today, and the questions that they have asked and how they were positively contributing to this session output. So thank you all. It was a wonderful, one of our wonderful sessions. Thank you so much, Professor Tara.
Thank you so much. Thank you so much. Yeah, sorry.
No, please go ahead.
I just wanted to say that it was a wonderful opportunity for me because this is something which I'm trying to develop into a larger treatise. So your questions and your are very, very important in shaping my own thoughts on some of these things. Thank you so much for this opportunity to the Jindal School of Global South and Dr. Hebatallah Adam, especially, who reached out to me. And thanks for this opportunity. Thank you very much. And all the participants, and wonderful questions.
Thank you so much, Professor.
Thank you. Thanks a lot.
Thank you.
Yeah.
Thank you so much.
Bye-bye. Really all the best.